You can take your 5% cap rate property, you can sell it. So you can sell that property for $200K on the market. And you can take that money and reinvest it into a 6% cap rate property. What's up everyone? Welcome to my third video on this channel. And in this video, we're going to be talking all about capitalization rates or cap rates. So if you've been an investor for any amount of time in real estate, whether that be 5 months or a year or 2 years, you've probably heard of the term cap rates before. But if you're brand new to real estate investing, welcome to this video. And this video is actually going to guide you throughout the process of understanding what cap rates are, how it's important in real estate, what it's all about, and really give you examples to solidify your understanding of cap rates. So without further ado, let's get into all of this. Cap rates, they're used for two major reasons. The first of which is to value properties, and the second of which is to compare investments. We'll get into those reasons a little bit later on as we get through the lessons. But let's talk about how to calculate cap rates. There are two ways to calculate cap rates. The first one being, you got to take your net operating income. So your net operating income is basically your unlevered cash flow. And what that means is that it's your cash flow assuming you have no debt. So it assumes you have no mortgage payments. So take your revenue minus all of your expenses, not including your mortgage payment. Because again, unlevered means you're not taking any debt. And that basically gives you your net operating income. So you take your net operating income and you divide it by the purchase price of the property, assuming you buy this property in all cash. So again, cap rates are unlevered returns of cash flow. It assumes that you take out no debt. Levered means you are taking out debt. So you're buying this property in all cash. So if the net operating income of a property that cost $100K is $1,000 and you buy that property for $100K, then your cap rate is going to be 1,000 divided by 100,000, which is just 10%. See, that's the first way of calculating cap rates. The second way is your NOI. Once again, nothing has changed. So your NOI divided by the market value of the property. And that's really different than the purchase price of the property. So let's say you manage to have a friend who sells you an off-market deal. So a deal or a house that's not listed on the MLS. So it's not out to the public. So you can obviously get this property for much cheaper than market value. He sells it to you for $100K. As soon as you buy it, you talk to realtors, you talk to other investors, and you find out, hey, if I take this property and I throw it on the MLS, I can probably get $200K for it. So the market value of the property is actually $200K, even though you purchased it for $100K. So following from the same example, the net operating income doesn't change. It's going to be $1,000. You're going to get the same rent for it. It's going to be the same amount of expenses because you have no mortgage payments, right? You're buying it all in cash. But instead, the market value is $200K. So it's $1,000 divided by $200K. Your cap rate is going to be 5% in this scenario. So why the hell would we ever divide it by market value? There are two reasons for that. The first one is to measure opportunity cost, aka comparing investments. So what I mean by that is that, let's continue off our example. Your buddy got you an off-market deal for $100K, $1,000 NOI, 10% cap rate. In reality, it should be a 5% cap rate property if you go out and sell it today. So you're technically holding on to a 5% cap rate property that you bought at a 10% cap rate. So you did good for yourself already. You're making money right there based on that spread. But you're holding on to a 5% cap rate property. And in your area, your neighbors, this entire street of yours, the cap rate is actually 6%. The average cap rate of all the houses around you, they're 6%. And you're holding on to a 5% cap rate property. So the opportunity cost there is that you can take your 5% cap rate property, you can sell it. So you can sell that property for $200K on the market. And you can take that money and reinvest it into a 6% cap rate property. So you can only do this when you're looking at market value, right? You can calculate, hey, what is the cap rate of the property I'm holding right now? How does it compare to the other properties around me? What are the cap rates of the other properties around me? If the cap rate of the other properties around me are greater, then hey, maybe I should sell this lower cap rate property and invest that money into the higher cap rate properties. And that's how it measures opportunity cost. Second thing is that the purchase price could be undefined. So let's say that your best friend gives you this property at $0, or let's say even a penny or something like that, right? Almost $0. So what is the cap rate? It's going to be $1,000 NOI divided by 0. Wait, that math doesn't check out, right? That means it's undefined. And this is also why we'd be using market value to calculate cap rates. And generally, as you'll see later on in the video, you want to use both methods to calculate cap rates. Your cap rate also measures payback, right? So let's say that your NOI is actually $1,000. Well, oh, sorry, it should actually be 10K. So let's assume your NOI is 10K. You bought the property for 100K, right? Its cap rate is 10%. Am I right? And so what's the payback? How long will it take for the property to pay back the entire 100K that you bought the property in cash with? It'll take it 10 years as well. So cap rate also indirectly measures your payback period of how long it'll take for you to pay back the purchase price of the property at what you bought it for. Let's go back to the first point where I said that we use cap rates to value properties. So let's assume that our current property has an NOI of 10K every single year. And we look around the properties beside us and around our neighborhood, and we know that these properties generally sell at a 10% cap rate, right? So if we know that properties that are comparable to ours and around our area and neighborhood sell for a 10% cap rate, and our property is generating a 10K NOI, we could actually reverse engineer this formula of NOI divided by market value equals cap rate. So we can work backwards and figure out what the market value of the property is. Hence, we can value the property. So let's actually plug it in. NOI is 10K. We divide that by market value, right? So value, which we don't know, that's what we're trying to solve for, and is equal to a 10% cap rate, because that's what comparable properties around the area are selling for. So if we work backwards, we can see that the market value, the MB, market value, will actually work out to be 100K. 100K. So we could use cap rates to value properties. Now that we got all of the lessons or learnings out of the way, let's really go through an example to drill the concept down in your head, right? So in this example, we're carrying off of what we kept on saying before. We purchased a property for 100K, but we got this property off market from a buddy of ours, right? It rents for, let's say, $1,000 per month, and the expenses are $500 per month. So we're going to assume that we bought this property in all cash, so there's no mortgage payments, and we bought the property 100K, all money. First step, what we're going to do is we're going to calculate the net operating income, and that is going to be your revenue minus your operating expenses. So $1,000 of rent times 12, because it's 12 months in a year, minus $500 of expenses times 12 months in a year, and that's going to give us $6,000 of NOI every single year, right? So the second step is to calculate the cap rate using method 1. So we bought this property. What cap rate did we buy this property at, right? We bought this property at 6,000 divided by 100K. So we bought this property at a 6% cap rate, right? Now let's go ahead and assume we bought this property around in the Scarborough area. So Scarborough. And Toronto's average cap rate is, we'll go with it's 4%. Toronto's average cap rate is 4%, right? And we bought this property in Scarborough for 6%, which is a part of Toronto. So is this a good investment or is this a bad investment? Well, on initial thought, we think it's an awesome investment, right? Just because we bought this property at a 6% cap rate. Toronto's cap rate's 4%. We got a good deal. We're getting a great return compared to all of the other properties in Toronto. Slow your horses down. There's much more things to consider. And the first thing to consider is your area. So our area is going to be Toronto, right? But we got to drill down a little bit deeper. We know that Toronto's cap rate is 4%. We bought this property for 6%. But we got to drill down on the neighborhood level. So we bought the property in Scarborough, right? What are Scarborough's cap rates? Because Toronto's a big region. Downtown Toronto's cap rates are, let's say, around 3%, right? And we can say that in North York, the cap rates are 4%, right? In Scarborough, what's the average cap rate in Scarborough? Toronto's a huge region. Let's say that the average cap rate in Scarborough is 7%. So, does our investment actually look really that good? We bought it at a 6% cap rate, but the cap rates in Scarborough are going for 7%. Deal doesn't look that sweet now, right? So we have to drill down to cap rates on a neighborhood level to compare whether the investment is good or not. Let's instead say that, sure, that Scarborough's cap rates are 4%. Now, is this a good investment? We bought at a 6% cap rate. The going cap rate in Scarborough is 4%. Awesome. We got a great return on this property. That's it, right? Awesome investment. No, not exactly. This is one more thing that we also need to keep in mind, and that's the asset class or the type of asset that you bought in real estate, right? So let's say that this property that we bought is actually a condo. It's a condo in Scarborough, right? And the condo, we bought it at a 6% cap rate. We know that Scarborough's cap rates are actually 4%. Oh man, we got a good investment? Not exactly. Let's say that the cap rate in Scarborough is 4%, and this is for single family homes. The cap rate in Scarborough for condos are actually 7%. Let's say the cap rates in Scarborough for condos are actually 7%. Now, is this a good deal? So when we compared our 6% cap rate that we bought in Scarborough to the 4% average cap rate in Toronto, we said it was a good deal. But when we drilled down deeper into the neighborhood level and we saw that, oh, Scarborough's cap rates are 4%, we still said it was a good deal. And then when we drilled down deeper and said that, hey, our 6% cap rate was for a condo in Scarborough, and we drilled deeper and saw that, hey, even though the neighborhood of Scarborough has a 4% cap rate, the cap rate for Scarborough condos are actually 7% because the type of real estate matters, whether it's a duplex, a bigger multifamily, whether it's a condo, whether it's a single family home, detached home, townhouse, that impacts the cap rate. When we drilled down to the level and we saw that, hey, it's a 7% cap rate for condos in the Scarborough area, we know that we didn't really get a good deal because we bought this property at a 6% cap rate, right? Hopefully that example made sense. Now we're going to go to example number 2. We're just going to continue off the same assumptions that we made before, but I'm going to erase all of this stuff about the neighborhood and the asset class, okay? But everything else we're going to keep the same. So we bought a property off market from a buddy of ours at $100K, rent $1,000 a month, expenses $500 a month, NOI $6,000 a year, cap rate's going to be $6,000 divided by $100K, which is 6%. And we're saying that, okay, we bought this property at a 6% cap rate, but we know that the market value of this property, if we threw it on the MLS, is actually $200K. So using method number 2 to calculate cap rates, it's going to be actually $6,000. Our NOI doesn't change because we have no mortgage payments. We bought this in all cash. $6,000 divided by $200K. Oh crap, this writing is disgusting. But that's going to be a 3% cap rate. So if we use the formula number 2 to calculate what cap rate is, we see that our cap rate's actually 3% right now, right? And let's compare it to Toronto's cap rate. Toronto's cap rate's 4%, okay? And is our investment good or is it bad, right? So we bought this property in Scarborough for a 3% cap rate. Let's say the neighborhood of Scarborough has a 5% cap rate, okay? And this is a condo. Let's say the condo market in Scarborough had a 7% cap rate. So when we look at the property that we bought it at a 6% cap rate. And now we can sell this property at a 3% cap rate. What exactly does that mean? That means we made a hell of a lot of money, right? We bought that property undervalued at 6%. We talked to all of our realtors. We talked to all of our friends. We talked to people who understand the market. And they told us that this property that we have here, we can sell it for $200K, and that puts the cap rate at 3%. And now we look around the market and see, hey, in Scarborough, we can actually buy 7% cap rate properties. So if we were just to say, okay, fuck that, we're not investing in any other Scarborough properties, we're too lazy, we're just going to hold on to this property, there's an opportunity cost there because you're holding on to a property that has a 3% cap rate. You're holding on to a property that has a 3% cap rate, and you can sell this property for 200K, and you can take all that money and deploy it into 7 cap rate properties that have 7% cap rate. But if you were to say, fuck that, we're just holding on to this property, you can't deploy any capital, and that's where the opportunity cost comes in. You are holding on to a property with a 3% cap rate when there are 7% cap rate properties out there, right? So what the smart thing would do is sell this property, get 200K, take all that 200K and deploy it into other properties that are generating 7% cap rates. Essentially, this wraps everything up for today. Hope it all makes sense. Thank you guys again so much for watching, and please like the video if you like the video. Please comment down below if you have any questions. You can reach out to me on Instagram at AustinYeh6, AUSTINYEH6. The link's going to be down there below. There you can follow my journey, see day-to-day updates on what's going on in my life. And also, please subscribe to this YouTube channel to keep updated with all up-to-date content, to see what I'm putting out there, and to follow me on my journey to financial independence, which it's officially going to be, I think, close to 7 months since I started my journey. Anyways, guys, thank you so much for watching, and I'll see you guys next time. Peace!